Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Markets are doing reasonably well in the last few days, and you have to argue that the global market support is visible in a period of heightened macro events, both from geopolitics as well as from central banking action. So, a good time to get in somebody who looks at cycles, both global and local, to try and tell us how is he thinking about the markets. And by the way, at the same time, he's in a self-confessed fashion, he says that he looks at businesses more closely than just the macro. Siddhartha Bhaiya of A Equitas joins us right now on the show. Siddharth, great having you. Thanks for taking the time out.
Good morning, Neeraj. Good morning. Pleasure to be on the show.
Thank you so much. Siddharth, I know you look at cycles very, very closely, but I would want to start off with, the biggest debate and wonder if there is merit in that debate per se, simply because if people who eat, sleep, breathe economics for a living, if they are on opposite sides, then I don't know what other mere mortals can do. But my question is this: are you trying to position portfolios at your end, second guessing what could happen to the interest rate cycle worldwide and in India, because the expectations around inflation and rates keep on changing at the turn of a coin?
Yeah, it's very difficult, honestly, Neeraj, to take a very short-term call, right, on interest rates. But mm, but my sense is that, as far as India is concerned, your interest rate cycle for the time being looks like we've hit a pause button. Is it the end of the interest rate cycle? I don't know. Look, the economy is extremely, extremely strong.
Yeah,
right. So
that's true. Okay, never mind. Let's just give Siddharth a minute.
Sorry. The economy is extremely, extremely strong. So the growth figures.
Siddharth, maybe take a minute. Doesn't matter. Let me just try and guys, viewers, let's just give Siddharth Bhaiya a minute to just catch his breath. But here's what I would want to tell you, that what we will bring on the show today. So I would love to talk to him about this question that I started off with, which is the interest rate cycles and what could happen, presumably, to risk assets positioning, as the case may be. What we will try and understand from him is, for people who followed our conversations, he's fairly constructive for a while on, for example, metals, because he believes that people who don't understand cycles in commodities fail to look at the larger picture when it comes to metals. So I will talk to him about that. I will talk to him about the upcoming capex cycle, because they've been constructive on capex and now it is coming to the fore. And you can see that in the way the order books, as well as the market positioning of some of the sell side analysts as well, is coming not just for the industrials, but for the other pockets as well, like railways, for example. So we're lovely to talk to him about a lot of domestic facing sectors and then pepper it in with some questions around what the globe could be like. Siddharth, I hope all is okay.
Yeah, that's fine, Neeraj. Just a little but as you said, coming back to your question, I think the interest rate cycle in India for the time being looks like we've hit a pause. RBI in the last two policy meetings hasn't increased interest rates. Going forward, if the growth remains strong, which is extremely strong in India, I don't see that this is the end of the interest rate cycle. So maybe we could have an extended pause, and then maybe later on, as and when inflation rears up its head again, maybe you could have an increase in interest rate. But we'll take a call as and when the situation plays out. As of now, yes, domestically looks like we are at a pause, and internationally also, right? The Fed probably is more likely than not, for the time being, done with interest rate hikes.
So are you constructive risk assets currently, Siddharth? Are you, for example, fully invested? If you had a chance to lever up, would you do that as well? Because there are equal number of bulls and bears when it comes to the Indian markets. Would love to understand how are you thinking about it.
To be honest with you, there's absolutely no reason right now not to be fully invested in risk assets in India. Right? The economy is on all fronts, it's firing on all cylinders, whether it's GST collections. IIP growth came in yesterday and it surprised on the upside, right? So everything as far as government finances are in great shape, interest rates are going down, So as of now, to be honest with you, India seems best position in the world, and the world itself is kind of slightly looking up.
Interesting. So the current year TTM or FY24 valuations being this 1 standard deviation, 1.5 standard deviation above normal relative to EMs, etc., that argument doesn't worry you?
So to be honest, yes, Neeraj, the markets are slightly overvalued. Very difficult to find deep value stocks in this current environment. Our portfolio itself has gone up 50%. So very difficult. I wouldn't say that this is you get screaming buys in this market. There are pockets of value but yes, the valuations were a lot cheaper a year back.
Got it. Okay. Okay. Siddharth, I would love to kind of take on from some conversation points that we had in the last conversations that we've had. So start off with BFSI and the argument around a pause or a future pullback in interest rates in India, and what does that do to a BFSI portfolio by itself and overall? Because some people would say, okay, swap or start and make a shift out of banks into NBFCs, but keep banks because the earnings growth at banks will probably still look very solid because of the credit growth. Now, help us understand how you think about this.
See, so to be honest with you, BFSI as a sector is something which we've completely avoided, right? We didn't find the valuations attractive, and we thought that the sector was extremely overrun. Have we been vindicated in our stance? Yes, right. Last 1 year, the bank Nifty is practically up 3, 4, 5%, and our portfolio is up 50%. And if you remember, Neeraj, we said we're looking at where the flow of credit is going to be. And the flow of credit for the last 1 year has gone towards infrastructure, has gone towards CapEx. And that is the sector that we were invested in. And that is the sector which has done really, really well. So yes, there are enough people out there who can give you a view on BFSI, and majority of them will be positive. But we don't own anything in BFSI.
And you're not tempted to get into NBFCs as well. Some NBFCs are not that expensive. The interest rate turn might help them, so on and so forth. Not interested.
See, our call is that the flow of money, the flow of credit is going to go from the consumer to the infrastructure sector to the B2B borrower, to the corporate sector, right? And we've seen that cycle has changed. 2010 to 2020 was all about consumption. It was all about flow of credit to the consumer. The industry, the government was starved for capital. The consumers were, the beneficiaries of low interest rates. Right now, what we are seeing is the credit is not flowing to consumers. It is rather flowing to industry and to the government.
Mm-hmm. So in some sense, maybe a decade is too long a call to make, but could it be that from a decade of B2C, we might now be in a decade of B2B businesses making hay at the same time?
We've already been in B2B for the last 2 years.
Last 2 years, yeah. But that's what I'm saying. Yeah. So staying ahead as well, you think that could be the case?
So we take a call on a regular basis. Our call is that this is going to be a very long-term cycle, maybe 5 years, 7 years. It could be 3 years, it could be 5 years, it could be 10 years. We'll let it play out. And we'll take a call. At the turn, you will come to know. In 2020, right, everybody was only talking about consumption. Nobody was talking about B2B. Nobody was talking about infrastructure. So when everybody talks about infrastructure, stocks, quoted 50, 60p multiple, probably that would be the end of, the infrastructure and the CapEx cycle.
Okay, so here's my question, Siddharth. Skeptics around industrials, the ABBs and the likes are actually trading fairly expensive. So skeptics argue about the starting valuations not being great, and people who are optimistic on them, I reckon those, I haven't read the UBS note, but they have a target of 5,000. But be that as it may, I'm not trying to talk about specifically a stock. What I'm trying to get to is that people who are constructive argue that if you look at the trailing 12-month cycle, these guys will look expensive. But if you compare it to what happened in 2003, 2008, EBITDA really rakes up very, very quickly. I would love to understand how you think about these names, because frankly, save for 1 or 2 names, most names in the industrial space, or at least the capital goods space, are expensive.
So to be honest with you, it's not. If you take out maybe an ABB or Siemens, Larsen is not terribly expensive.
Right.
Larsen is not. You go beyond that. You look at some of the bigger companies, KEC, Kalpataru, right? They're not. You go down below that. A lot of these companies are just seeing the turn of the cycle. And with what happens with cap goods companies is revenue grows exponential. Their order books today are 3x of what they were 2 years back. There's a 300% jump. So you're going to see massive increase as far as execution is concerned, right? So just not capex, but we're talking about infrastructure as well. The government is going to spend massively. We did a compilation of the number of orders that were released in the month of March, and it was insane. I've been in the markets for 20 years, and I've never seen anything like that.
Wow.
Never seen anything like that. What the kind of capex? First quarter is usually a lean quarter as far as order flow is concerned, and we are still seeing every single day. Torrent Power won or 25,000 crore order a couple of days back, right? So whether it is energy, whether it is water, I speak to companies who are doing water supply projects in UP, and they said we've never seen, government payments so fast and so efficient. They say we get our payments within 7 days of submitting our bill. So the government is flush with funds, with GST collections and income tax collections being so strong, and they're pumping it back into the infrastructure, and this is kind of creating a virtuous effect.
Yeah. Okay. So I stand corrected on that, and thank you for correcting me. I love being corrected, frankly, on air. No, but I love it because, frankly, it is good to get your numbers straight. Here's one number, though, I would want to understand from you. We were speaking to a railway company before we did an interview with you. Their order book is nearly 10x of their FY23 revenues. Now, it's a space that has been shunned for, and maybe for right reasons, for the last so many years. Has it turned for the better? Are you getting confidence as well on some of these shunned pockets? Defense, PSU banks, railways?
It is, right? Defense, you look at it, and this government has been transformational in so many things, right? Nobody thought India could, we were for so long so dependent on imports as far as defense were concerned. And look at what the government has done in the last 4 years, 5 years on the defense front. Railways, you look at it, majority of the companies, their order books are full. In fact, I spoke to a company a few days back, and they said we are L1 in a project, but humko dekhna hai hum order lenge ke nahi. And I thought, you can't do that. Right?
Who thought that could happen?
Yeah, right. So this is it. Everybody is, as far as infrastructure companies is concerned, they're full to the brim. And we're seeing hydro. You look at the amount of investments that is happening in the hydro sector, power sector, distribution, RDSS, railways, defense, you name it, and you're seeing massive spending happening. So the tide has turned towards these companies. You had small cap fund come and buy Titagar wagon. The stock has gone up 30x in the last 20x in the last 4 years, 5 years.
Yeah.
And so it is the tide is turning, and eventually at some point in time, these companies, like all other cycles, will eventually get bid up.
Got it. Well, that's the company that we spoke to, wherein the order book is 10x.
I thought as well.
Okay. Siddharth, I remember a conversation with you sometime last year when metals were kind of swaying down after having a really good run in the COVID period, right? And you had mentioned then that people who don't understand the metal cycles will grumble, but maybe this is an opportunity for people who understand the metal cycle. Now, the commentary that seems to be coming out off late is that maybe steel has bottomed out. Maybe the volume growth because of the infra spends will be very strong, and therefore the fortunes of the company will turn again. I would love to understand from you how you're thinking about it.
So two things here. First is China. China has been a big disappointment as far as the global economy is being concerned, right? India is firing on all cylinders. In fact, we own 3 metal stocks. 2 of them have just made an all-time high. Okay. And generally, I don't take name, but one of them is Jindal Stainless, which is a big beneficiary of the capex cycle and the infrastructure cycle. And second is Sada Energy. So both of these companies have not just rallied more than 100% in the last 1 year, but have also made new lifetime highs. So while China has been a big spoilsport as far as the global economy is concerned, India is firing on all cylinders. So what happened for 2 quarters maybe is global commodity prices kept on going down. And typically, Neeraj, what happens is when prices go down, volumes take a hit. But because growth in India has been so strong, that volume have been very, very strong for a lot of Indian commodity companies or metal companies. So yes, there is a short-term blip, right? And 1 year to me is a short-term blip in a long-term cycle. At some point in time, China will revive likely. And you're going to see the balance sheets are healthy for most of these companies. The volume growth is very strong. A lot of their high-cost inventory has got depleted and has been replaced by low-cost inventory. And hopefully their margins will come back again.
Got it. The last time you had made an interesting point on media. Now, here's a sector that for the last maybe 15 years has not gone anywhere in terms of stock market fortunes.
Yes.
Can it make a turn or is it difficult to say?
See, we find a lot of value. Media companies have always been cash-rich companies. They throw a lot of cash, right? And a lot of these companies have cash on their balance sheet. The valuation is very attractive. 15 years of practically no returns for a lot of these companies, whether you look at, and I'm not talking, and as with every sector, there are companies which we don't find attractive. Maybe out of 3 or 4 which are worth investing according to us. The valuations are attractive, the balance sheets are very strong, and stock price returns for the last 15 years have been poor, extremely under-owned. We own a print company which has done 4 buybacks in the last 5-6 years, and the stock price is corrected by 70-80% from the peak. 15 years returns have been negative, and it has more than 50% of its market cap in cash.
Yeah, sure. Easy to guess.
And it's available at 4-5 times earnings, So
sure, yeah, easy to guess. Yeah, I think the headline is grabbed by one particular company these days, and for the wrong reasons. But that notwithstanding, the pocket seems one of value for sure.
And it was Z. There were always questions around Z, right?
Yeah.
I hope you're talking about Z, and there were always questions as far as. And this was the same stocks which was available perpetually quoting at 50-60p multiple.
Yes. Yes.
It was always quoting at 50-60p multiple for a long time. It was part of the Nifty, right? And people said, oh, they've got great moat. The moat doesn't exist, right? All people are left is with the paper moat.
Yeah, it's just been unfortunate though, what's happening with that. But hopefully some good resolution comes in for the business and for the employees and for some loyal viewers as well.
Let's hope.
Yeah, I have a last 1 or 2 questions, Siddharth. One of them is around information technology, and then there is around the tech businesses per se, but IT first. Large cap, I mean, there seems to be a bit of a breaking of correlation between what the US tech does versus what India does. And Nasdaq has had a fabulous move. If indeed inflation comes off, then Apple's strength, so on and so forth, might all seem that might here to stay. But large cap IT has headwinds. Now, I would love to understand whether you are shunning IT as well at large, or do you believe that there is quote unquote value here?
So to be honest with you, we did see a couple of mid-cap IT companies. Unfortunately, we were fully invested, and they've run up quite a bit. The valuations were attractive, and the results were good. And 2-3 of them have rallied more than 60-70% in the last 3-4 months.
Mm-hmm.
Right. So, as you mentioned, large cap IT, a lot of headwinds, a lot of negative news, a lot of negative commentary from the management. But mid-cap IT, there are pockets where there is growth. Vertical specific, sector specific players are doing very, very well. So yes, as I said, the stocks haven't done anything for the last 12 to 15 months. And same, extremely popular at some point in time. Everybody was gung-ho about IT. I remember our first interview, and you were shocked when I said I don't own any IT. Right. But yeah, as I said, once the valuations are attractive, we will look at stocks.
Okay, so the valuations you believe are still not attractive.
Look, some of a little bit of the froth is corrected, right? Some of the IT stocks have corrected 30-40%. So we now focus on whether the future outlook improves or not.
Okay. My final question is on everything tech. I remember in 2020 or 21, companies said that, oh, we are insure tech, we are health tech, we are prop tech. Everything that had a tech element to it suddenly seemed very, very fancy. Then the actual tech businesses also came off quite rapidly, 60, 70, 80% maybe. What is your sense around that pocket now?
Neeraj, let me put it this way. 2 years back, 9:30 in BQ Prime, you only had tech companies. Today, you have infrastructure companies.
Yeah, well, that's true. My question is, will I have tech companies? Do you believe that could happen?
So, see, technology is an enabler.
Yeah.
AI is an enabler. Anyone who's going to adopt technology is the one who's going to survive, right? But at the end of the day, for a country like India, we need to spend on infrastructure. We need to spend on providing power to every citizen of the country. We need a better rail network. We need better airports. We are a growing economy. We will need to invest in that.
Okay.
Yes, and technology will be an enabler for that. So, am I a believer in AI? Yes, but do I need to go and buy AI stocks? No. Maybe I can use that in my own form and see how I can improve our processes.
Okay, well, get the drift. Siddharth, such a pleasure talking to you. Thank you for this time, and looking forward to talk to you more often. Of course, we have to do an episode of Insight together in the next season, so I'll be looking forward to that as well.
We'll do that. Yeah.
Great. Cheers. Thank you for your time today. Viewers, thanks for tuning in.